First Citizens coming in to buy part of SVB's deposit book. You know, you and your company and portfolio companies have some exposure to SVB. What do you make of the outcome?
I think it's not surprising. We were all hoping that somebody would come in and buy the bank just so that those relationships can continue. In terms of Fullen's exposure, you know, we work a lot with bootstrapped companies, and so they aren't really the core market for Silicon Valley banks. So we didn't have nearly as much exposure as some of our peers in the industry, which was lucky for us. But I think this is a good outcome in terms of making sure that that stability that was there for a long time continues for folks going forward. Though I do expect to see a change in underwriting policies around what profile of companies can get debt and on what terms relative to what we were seeing in the past.
Elodie, in every coffee meeting I've had, every phone call of the last 2 weeks, you know, VCs remind me that they're investing on a 10-year time horizon, right? But what have you made of the last couple of weeks? What do you think the impact's been to how you go about doing business?
Great question. So I think there are groups out there that have been relying on debt either as part of their initial investment strategy or more recently, we were hearing this in the last, call it 6 to 8 months. You know, there was a correction that happened in the public markets about a year ago, and it's taken some time for that correction to materialize in private market valuations. We were looking at companies over the last 2 quarters, and anytime we talked about, you know, their need for potential cash going forward, we got a lot of responses around we would rather take on debt than take on a down round. I suspect for those types of groups, that game is ended now, and there are going to have to be some corrections on the private side valuation. So from our perspective, it's sort of an overdue correction that we've been waiting for the last, you know, couple quarters, maybe a little bit longer. In terms of how it impacts, oh, go ahead.
No, I want to jump in and ask, you know, in that vein, what a term sheet looks like right now, because there were all these kind of big picture themes that we talked about January through early February, you know, bigger checks at slightly earlier stages, right? If you think Series B, that kind of all went away amid, you know, the tighter financial conditions conversation when SVB collapsed. What are you seeing in the term sheets that are coming across your desk?
So I would say I see it less in the term sheets other than, you know, valuations have rationalized compared to where they were in the last 18 to 24 months. I would say the largest change that we're seeing is actually a better alignment, I would call it, between founders and investors. So for the last few years, there's been a narrative in the market that more money at a higher valuation is the way to showcase founder friendliness. I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run. And we're starting to see a lot of founders who are asking more around how do you really partner with us as organizations and as individuals? Right. What type of value add are you bringing beyond a capital check? And so that focus on partnership combined with more rational valuations is definitely what we're seeing these days.
Did you just use the term founder friendly?
I did.
I think I've heard that before in the last few weeks and months. What does it mean?
Look, we've had a very specific definition of it here at Fullen, which was a dedication to making sure the companies that we partner with have all of the resources and opportunity to succeed. And for us, that's always meant we make sure that there's clear alignment between us as an investor and the company and the founders going in. So that doesn't necessarily mean the highest valuations. It means the right amount of capital for the strategy that they're looking to enact. I do think we've seen a game of let's raise as much as we can at the highest price, and getting to $1 billion as fast as possible is the right thing for us. That's the piece that has really fundamentally changed in terms of a definition of founder friendly, where folks now are realizing, you know, if you're crushed under $300-400 million of preference stack at a valuation that you're going to take 4 years to climb yourself out of, that's not a very friendly place to be. And so that is really changing the definition or what founders are looking for in terms of being more thoughtful, asking more questions of the investors in terms of what do you do to help your companies? How are you playing this longer? You know, to your point, it is a 10-year game, right? But it's a 10-year game if the company can live for 10 years. If they're going to run out of cash in 18 months because there isn't the proper partnership at the board level where investors are really, you know, challenging the founders as opposed to just letting them run wild. I think that's a big piece of what we're seeing change in the market.
And the health of the startups themselves. Fullen's really focused on software in particular, but also e-commerce, mobile applications. What are you excited about right now?
Well, I think if you're an investor who's been through a downturn, then you kind of know what's coming, which is, again, a closer alignment on entry point between funds and the companies that they work with. There are a lot of counter-cyclical businesses out there that do very well in these kinds of times. So we're familiar with a business that enables you to sell your old clothes via a mobile app to others on the platform. That's a kind of company that can do reasonably well in good times. But as economic pressures start to mount, folks may be looking for a way to make more money. And so they're more eager to part ways with items of clothing they haven't worn recently. And similarly, if you're looking to save money, maybe you're going to be looking to buy secondhand instead of buying firsthand. So that's an example of the type of countercyclical businesses that we would see come out of these times. I think more broadly, when you have more pressure economically and you have less capital going into the market, you start to see a lot of small advantages. So you're able to hire better talent for a more rational price. You're able to get more bang for your buck when it comes to marketing, and all of your dollars don't just go to the Facebook and Googles of the word. So I do think that you'll start to see businesses be able to actually be built more efficiently than we've seen in the last few years.